Credit cards are the most profitable business for any bank or lender due to its high interest rates. And if you look at the companies listed in the stock exchange, you will only find one company that issues credit card. That is none other than SBI Cards. Hello everyone, this is the Market Analyst and today we will discuss SBI Cards and its business. We will also look at the major factors such as key strength, future growth prospects, key risks and financials so that you can get an idea of the company if you are planning to invest in it. SBI Cards and Payment Services Limited is in the business of issuing credit cards and it was incorporated in 1998 as a subsidiary of India's largest public sector bank, State Bank of India. As of March 31st, 2021, it is the country's second largest credit card issuer with over 11.8 million cardholders. The corporate office is located in Gurgaon and registered office is in New Delhi. The company also has 22 branches with over 140 sourcing locations that employs over 38,000 sales agents, 4 call centers and over 6,000 collection agents across 140 plus cities in India. With such a mammoth workforce, what exactly is the company's product portfolio? Let's take a look at it. The company's product portfolio can be divided into 3 segments. Number 1 is co-branded segment, second, banking partners, and thirdly, SBI Card branded credit cards. To explain further, the company has co-brand tie-ups in the travel, fuel, fashion, healthcare, and mobility industries. This includes tie-up with Air India, Apollo Hospital, PPCL, Mumbai Metro, IRCTC, Ola Money, etc. The company has also entered into a partnership with Paytm to launch a co-branded credit card and with Google Pay to support credit card based on the Google Pay platform. Its banking partners include Central Bank, Allahabad Bank, Federal Bank and South Indian Bank. And for the third one, SBI Card also offers 4 primary SBI Card branded credit cards. They are namely Simply Save, Simply Click, Prime and Elite, with each of these catering to a varying set of cardholder needs. So with such a huge partner base, what are the key strengths of the company? The first strength of the company is the company's business itself. Credit card is the most profitable business for any bank or lender. And the reason is simple. Credit card interest rates are very high and this makes it one of the most profitable business for any lender, be it public or private sector. The second strength is of course the well-established parent company. The SBI Card's most significant advantage is its strong holding company. State Bank of India has built the strongest and most trustworthy brand in the industry over the many years. SBI Cards, on the other hand, can leverage on its brand status and gain customer trust. From its parent company SBI, the company also have access to ready-made database of potential customers. In addition, SBI is involved in the cross-selling of credit cards as a value good. So, SBI Cards will be able to use the parent company's vast physical network in this manner. And that leads to our third key strength, that is, improving market position. During the last few years, the company has grown faster than industry average by increasing its market share in terms of total cards in force to 18.7% as of August 31st, 2020. Surprisingly, this figure was only 13.2% at the end of fiscal 2013. Due to this, SBI Cards has become the second largest player in the credit card industry in terms of market share, and in terms of spending, it commanded 20.2% market share in first half of fiscal year 2021. Also, the company is expected to continue to benefit from its strong distribution network and State Bank of India's large client base, as well as further improve its market share over the medium term. With that being said, let's take a look at the future growth prospects of the company. The first opportunity is the multi-decade growth. That is, credit card penetration in India is extremely low as compared with other markets, even after considering India's low per capita GDP. According to a Morgan Stanley report, India's credit card market should comfortably deliver a CAGR of 15% in the next 15 years, and SBI Cards being among the top players is likely to get a huge benefit out of it. Next one is e-commerce adopting fully cashless transactions. That is, In the e-commerce industry, only 30 to 35% of payments are made via credit card, with the majority of payments made using cash on delivery method. The users shift from cash on delivery to using credit card due to special discounts and offers provided on credit cards can also benefit companies like SBI Cards. Furthermore, since the e-commerce industry is still in its early stages, its growth will have a direct impact on the credit card industry in India. India's young population and rising opportunity. The business of credit cards in India is at a very early stage. As per DRHP, our country has an urban population of approximately 45 million people, and credit cards are mostly issued to this population. As of today, India has approximately 5 crore credit cards, which is very small portion of the urban population. Furthermore, India's younger generations use credit cards more frequently than elders. India has one of the world's youngest populations. The average age of Indian population is 28.4, making it the youngest when compared to the United States, which is of 38, China at 38, Russia at 39, and Japan at 48. This factor is also a driving force for credit card companies. With all the positive facts, let's try to figure out the key risks of the company. The first key risk is higher dependency on promoters. Even though the company's advantage is dependence on SBI, there is also a negative side to it. That is, there is no particular agreement or deal that says the parent company should only take cards issued by SBIC. So, if in case SBI decides to have an additional deal with any third party, SBIC simply cannot say no. The second risk is unsecured nature of the business. Despite the fact that the company is engaged in a profitable business, it is unsecured in nature. If you look at the gross non-performing assets levels, which were at low as 2.1% on March 31st, 2020, it increased to 4.99% on March 31st, 2021 as a result of the pandemic. In response to the pandemic, management has implemented a number of measures, including tightened credit policy, increased sourcing through the bank channel, increased income cutoffs for new accounts, and lowered credit risk for risky customers. Having said that, the recovery from the COVID-19 pandemic is well underway. The next challenge is in the form of regulatory risk. That is, regulatory restrictions on yields and fees are a potential risk for the company. For example, during the COVID-19 lockdown, the company had to face a moratorium restriction which impacted the overall revenue, and this was not within the company's control as it was directed from Reserve Bank of India and had to go through a Supreme Court verdict before everything started to turn normal. Now, let's try to compare SBI Card with peers in the market to understand where the company is standing. So, within the credit card segment, HDFC Bank is the market leader with the highest market share of 23.61%. HDFC Bank has been able to maintain its leadership status despite getting banned by the Reserve Bank of India from issuing any credit cards that lasted around 8 months. At the second position, SBI Cards share is at 19.17%, while ICICI Bank comes at third with the 17.57% share. The top 4 credit card players have a huge market share of 71.71% in the Indian credit card market, while the rest of the 28 banks have a market share of less than 5% each. At the same time, we have to keep in mind that SBI Card is the only listed player and as well as a separate subsidiary. Other banks have credit card businesses within the bank and is not a separate entity either. In other words, the company will be able to focus completely on its credit card business. That being said, let's try to understand the shareholding patterns of the company. In the September quarter of 2021, SBI Card's parent company, SBI, held the most shares, and this is around 69.37%, while foreign institutions held 13.07%. Domestic institutional investors held 9.71%, with public holding on to only 7.86%. The biggest takeaway here is that both the DIIs and FIIs increased their holdings compared to June quarter of 2021. Now, before we go into the financial status of the company, let's try to understand how the business earns revenue. SBI Card generates three types of income. The first one is non-interest income, which is primarily comprised of fee-based income such as interchange fees, late fees, and annual fees, among others. The second one is interest income on credit card loans. And thirdly is MDR or merchant discount rate. This is the fee which company charges from the merchant for providing a facility to pay when a customer buys a product from the shop. Here, three business comes into picture. To facilitate the payment option for customers with their purchase, credit card company charges the merchant a 2 to 3% MDR fee. The credit card company alone won't be able to process this transaction, so then comes network providers such as MasterCard, Visa, etc. Now this acts as a payment gateway business, making it possible for funds to be transferred from a credit card company to a merchant's bank account. Finally, neither of the preceding business is possible without a POS machine, that is, the machine that you swipe your card on. So now we have a third party company as well, that is, the provider of swap machines. Here, if the credit card company is charging rupees 100 as MDR fees from the merchant, then 75 to 80% goes to the credit card company. That is, for example, State Bank of India's credit card company. And 20 to 25% will go to the network provider, that is, MasterCard or Visa. And the rest will go to the machine provider where you swipe your card. Now, let's try to understand the company from its financial perspective. The company's revenue has been on an increasing trend since 2018, where it was only 1,438 crores, but it went on to touch 9,301 crores by 21st of March in 2021. However, due to COVID-19, 2020 witnessed a relatively flat earnings for the company. Net profit also took a dip because of that. However, it remained well above 2019 levels, but with only at 985 crores. The company has a PE ratio of 102 and an ROCE of 10.1% as well as 17% of ROE. The company's biggest gains come from net interest income, and that took a huge hit when RBI announced moratorium during the lockdown, but we are witnessing a gradual recovery from that. The company's capital adequacy ratio, which is nothing but a certain amount of money required to be kept with them to ensure the customer's liquidity protection. This is well above RBI requirement of 15%, ensuring that the company is cash rich as well. Now, here are some important notes from the company's investor presentation for second quarter of financial year 2021. The profit after tax went on to touch 345 crores, which is 67% up year on year. New accounts increased by 39%, retail spends increased by 41%, corporate spends increased to 80% and receivables increased to 12%. Furthermore, the increasing asset quality was notable because the gross non-performing asset was at 3.36%, which used to be around 7.46% in the previous year, and non-performing assets stood at 0.91%, which used to be around 2.7% as of September 2020. With a mixed bag of financials as well as with a market cap of over 1 lakh crore, the big question is the valuation justifiable? As we are moving towards a cashless economy, the growth of credit card is inevitable. While most think that UPI is a competition, UPI is yet to give a credit option for the customers. The only risk credit card companies have is the impact on business due to the slowdown in the economy. The worst time for the economy is already over as we are moving away from the pandemic stage altogether. This also means that the worst is over for the credit card companies as well, with the rising salaried population and movement of unorganized sector towards the organized sector are likely to boost the opportunities for these credit card companies. Also, due to better adoption of technology and massive digitization of economy, the credit card usage and user base is most likely to go up further. With the scope for further growth and expansion unlike developed nations where credit card use is common, we believe the company can grow further and reach newer heights. That being said, we hope you liked this video and please let us know what you feel about SBI Cards in the comment section. Don't forget to hit the like button so that it will encourage us to bring more videos on such great companies in our country. Also, to show your support, you can subscribe to our channel and press the bell icon so that you don't miss out on our updates. See you guys on the next one.